I now hand the conference over to Ms. Bunny Babji from JM Financial. Thank you, and over to you, ma'am.
Thank you. Good evening, everybody, and welcome to the Bajaj Finance earnings call to discuss the Q4FY21 results. To discuss the same, we have on the call Mr. Rakesh Jain, Managing Director, Mr. Sandeep Jain, Chief Financial Officer, Mr. Atul Jain, Chief Executive Officer, Bajaj Housing Finance, Mr. Anup Saha, Deputy Chief Executive Officer, Bajaj Finance, Mr. Deepak Bagati, President Collections, and Mr. Fakhari Sarjan, Chief Risk Officer. May I request the MD, Mr. Rakesh Jain, to take us through the financial highlights, post which we can open the floor for Q&A session. Over to you,
sir. Good evening and good morning to some of you who are on other hemisphere. We've uploaded the press release. I think we are waiting for BSE and NSE to upload the investor deck, and that's why we've not uploaded in our section of our website. It's been done so now, I'm told, so you can refer to that. But I'll run through a few slides quickly to give you texture on the quarter that went by. Yeah. Overall, if I look at the assessment of the quarter, I would say, given the circumstances, a good quarter for the company. With I'm on panel number 4, with most lead financial indicators fundamentally normalizing to pre-COVID levels. Our business transformation plan that we've been sharing over the last 3 quarters is on track. We expect to launch the overall 3-in-1 financial services infrastructure in a phased manner between August and September as a company. If you look at the quick financial highlights, on a year-on-year basis, we ended March 31st with AUM of just a tad below 153,000 crores, a growth of 4%. OPEX to NIM versus 31% last year came in at 34.5%, and I'll cover that with some texture in a moment. PAT came in at 1,347 crores. It's a growth of 42%, but the year-on-year comparisons are not really relevant fully, but I'll still, and that will remain so the case for the next 4 quarters as we go from here. So this is, we'll have to live with some degree of, I would say, we'll have to live with these numbers at least for the next 3-4 quarters. ROE came in at 3.7% versus not annualized, which is versus 2.9%. Net NPA came in at 75 basis points versus 65 basis points as of March 31st. Let's quickly run through the key numbers. Overall AUM, as I said, I'm on panel 5, 153,000 crores, year-on-year growth of 4%. Core AUM growth was 9,400 crores versus a year ago 2,061 crores. If you look at the AUM growth between Q1, Q2, Q3 of FY20, on an average, the AUM growth on a quarterly basis was 9,700 odd crores. So we are within the 95-97% run rate of quarterly AUM growth in Q4. We were at 8,500 crore core AUM growth in Q3, and that's moved to 9,400 crores. In terms of accounts booked, the company booked 5.5 million accounts versus 6 million accounts a year ago. We have updated the investors in general about 2 businesses that we have put either in a pause mode or have constrained their lending, mainly our wallet loans business, which used to be 175 to 200,000 accounts. That business kept in abeyance, and our retail EMI card spends business that is capped at this point in time at 50,000 accounts per month versus 150,000 accounts that they used to do pre-COVID. Adjusted for this, we on an apple-to-apple basis, we are at just about 6 million accounts on a quarterly basis. The company added the new customer acquisition run rate has come back to pre-COVID levels at 2.26 million new customers we acquired in Q4. In general, that's long-term guidance in general is between 7 to 8 million customers in a year. In the last 2 quarters, we fundamentally hit a 4 million kind of number. So we are well on track to normalizing new customer acquisition in the last 2 quarters to pre-COVID levels. Overall franchise was 48.6 million. The cross-sell franchise was 27 million. Overall, on a year-on-year basis, growth of 27 million gives us a reasonably good platform to grow from once we are out of the second wave as a country. Our total geographic footprint, 3,000, just a tad below 3,000 locations and 110,000 distribution points. In terms of margin profile, we are holding margin profile except mortgages. In the Q4 that went by, we took an interest reversal of 300 crores as compared to 122 crores that we were taking in Q4 last year. The interest reversal peaked in in Q3, that was 450 crores. It's already come down to 300 crores. We think it should fully normalize by Q3 back to 120 to 140 crore range. Overall cost of funds, we had shared that as we start to bring down our liquidity buffers, as we start to have greater confidence on growth, we will start to also improve our borrowing, which should fundamentally lead to reduced cost of funds given where the environment is. The overall cost of funds came in at 7.4% or 7.39% versus 8.37% a year ago. That's a close to 100 basis points differential. The liquidity buffer still held quite high. We expect to bring this down to about 9 to 10,000 crores in the current quarter as things normalize. As part of the process to bring down our cost of funds, we had shared even in Q3, we've now paid down close to 7,500 crores to banking system, to various banks, as part of our strategy to optimize. The deposits book, with the intent to continue to granularize our liability balance sheet, grew 20%. It's now crossed 25,000 crore, just a tad below 26,000 crore at 25,803 crores. Overall, corporate and retail in that, retail is 77%, corporate is 23%. OPEX, as I said earlier, I would cover with a little bit of detail, came in at 34% versus last year at 31%. In absolute terms, OPEX was higher by 153 crores. Recovery commission in that line was higher by 140 crores, and employee-related costs were higher by 151 crores. OPEX, so part of it was mitigated by prudent management of other expenses. So while the number was higher by 300 crores, the net number was higher only by 153 odd crores. If you look at the ratio, which is OPEX to NIM ratio, fundamentally came in at 34.5 versus 31. In general, as we are looking at the management of OPEX, we are also clear that as the AUM starts to grow over the next 2-3 quarters and operating leverage starts to kick in, and we expect collections cost to fully normalize by Q3, you should start to see OPEX to NIM go back to pre-COVID levels, and hopefully by Q4 of the year, as we deliver business transformation fully, should start to look lower. Let's come to loan losses and provisions. We had guided that we would take between 1,200 to 1,250 crores, despite the fact that overall bounce, collection efficiencies, even as we were speaking in January, we're looking better. As a prudent measure, we decided to continue to take provisions. We took provisions of 1,231 crores. We also did accelerated write-off to the tune of 1,530 crores on account of COVID-related stress, and have fundamentally, on a go-forward basis, advanced our write-off policy. So this is really how you will see the numbers play out as we move from here. Overall, last year we, as a result of COVID, we entered FY21 with a 900 odd crores of COVID overlay. We are again entering, in a way, second wave with 840 odd crores of management overlay and macro provision. Gives us confidence that we can navigate through this crisis if it becomes one in an efficient stroke and effective manner. Gross NPA and net NPA, we think represents the health of the business, came in at 179 basis points and 75 basis points versus 161 and 65 basis points. The absolute net NPA was up only 200 crores from where it was in March 31st, 2020 at 1136 crores. Even in that, the AF, our auto finance portfolio and mortgages largely saw an increase of 300 odd crores, as you can see from the numbers here, from 419 to 609, that's 180 odd crores and another 120 odd crores. The non-overdue, which is portfolio which is current but classified as one-time restructuring, stood at 1,739 crores. It includes 918 crores of secured exposures, essentially again auto finance and mortgages, one large B2B retailer account of a strategic partnership that we have of 397 crores and 424 crores of unsecured assets. We have essentially considered the OTR book as indicator of significant increase in credit risk, and as a matter of prudence classified it as stage 2 assets. Against these assets we are holding a provision of 328 crores, which is a 20% provision. The non-OTR stage 2 assets stood at 5,000 crores against 3,150 crores. We hold a ECL provision of 1,240 crores, which is 25% against 589 crores, which was 19% that we held on against 3,000 crores of assets as of March 31st. Of the stage 2 book, secured assets are 3,000 crores and unsecured assets are 2,000 crores. Bounce rates, if I look at new origination over the last 6 months, fundamentally I'm on panel 7, clearly across businesses are in line or better than pre-COVID origination, ought to be in general. The current bucket bounce rate, which is good customer slipping into default, is back to pre-COVID levels now. The current bucket collection efficiencies are significantly better than prior to pre-COVID levels. The overall collection efficiencies across current bucket, bucket 1, bucket 2, which is 30 DPD, 60 DPD, even right of recovery continues to be significantly better than the experience that you had for a long. I mean, we have not experienced these kind of collection efficiencies across our portfolios in the last 14 years since at least I am running the company here. Overall gives us the confidence that we are well positioned to navigate any temporary stresses on account of second COVID wave that may actually emerge. PAT, we've talked about 1,347 crores versus 948 crores. The board of directors, given that we have accreted capital in the current year, have recommended a dividend of 10 rupees per share, which is 500%, which is the same as last year. Capital adequacy remained very strong at 28.34%, and Tier 1 in that was 25.1%. BHFL, the mortgage arm of the company, the AUM grew by 19% to just a tad below 39,000 crores. Its capital adequacy is again strong at 21.5%, and its post-tax its PAT for the quarter was 179 crores versus 91 crores, a growth of 97%. Overall, it's our view as management at this point in time that the company is entering FY22 or has entered FY22 on a reasonably strong footing, barring a, I would say, nationwide lockdown or extended lockdowns in large GDP contributing states, or a national lockdown leading to a moratorium. I think barring these three events, we are reasonably confident that of delivering our long-term guidance metrics in FY22. Given that we are at a moment where I'm in panel 8, we are in a moment where in general people are also asking as to what's the feel on the ground. I'll just give you some texture to give you where we think we stand and how some of our high frequency businesses are from an origination standpoint are doing at this point in time. We are virtually headed into end of April, and the disruption in general across the country started in the last 10-12 days. There are 7-8 points. Let me just quickly cover that. As I said, barring a national lockdown, 3 to 4 large GDP contributing states going into simultaneous lockdown for 3 to 5 weeks, and another moratorium on loan repayment. Barring these 3 big events, we are reasonably confident of delivering the long-term guidance matrix in FY22. We are also wiser. I think, having experienced the first wave, we believe that a disruption in the first quarter could be reasonably mitigated in the balance 3 quarters. I think none of us expected how quickly the economy will bounce back in September quarter, and the January quarter gives us confidence that even if it's a disruption of between April and May, a month is lost, let's say for a moment, hypothetically, it can definitely be made up in the balance 10 months of the year. Having said that, we are in a rapidly developing situation. We are watching the situation closely and are taking appropriate actions to navigate through this. So that while we are confident about it, we don't want to be overconfident about it, and we are watching the situation very, very closely. One of the things that we are also clear about from the last event is that we will remain fully open for business as a company in whichever way we can, despite the significant disruptions that one has seen in few states in the last 10-12 days. We remain open in line with local administration advisories. If you take the last 7-10 days, in general, we are still originating, even with larger state being 15-16% of the GDP, 15% of GDP comes from Maharashtra. Delhi is a very large market, and so on and so forth. We are still originating 50-55% of daily volume in our B2B business, given our deep distribution and widespread geographic footprint that we have. 80-85% of our business in B2C and SME businesses, and 40-50% of businesses in mortgages is really how last 7-8 days have fundamentally panned out. The reason for the confidence is also because I think in the last 1 year, last time around, we didn't have opportunity to be, none of us got any time. I think in the last 1 year, significantly augmented our digital capabilities to remain fully functional, whether it's for new origination, for full-fledged service, full-fledged operations, or collections in a work-from-home situation. I think there is significant preparedness and readiness to navigate through this a year later into the pandemic. We are also clear that we have 25-30%. You're aware we added 1,800 odd capacity in terms of staffing in our collections infrastructure. We are running with 25-30% extra collections infrastructure at this point in time as a company. We also have a view that...
So sorry to interrupt. So this is the operator. We are getting some disturbance from your line.
Understood. Got it. You just shut the window. Yeah. I'm just down to the last 2 points, and then I'll hand it over to your questions. Anyways, we are well on track to launch our 3-in-1 financial services in a phased manner between August and September. We also believe that if the recovery in general is a back-ended recovery given the COVID second wave, I think it will help us accelerate our market share as the economic momentum accelerates, is really what our point of view at this point in time is. There has been no cuts that you've taken so far in the last 15 days. The risk and collections data is not warranting any kind of risk stance change at this point in time. However, we'll continue to remain data dependent as a company, and we'll make risk decisions as May opens up and so on and so forth. I think, as I said, we are a lot more prepared. I think the business continuity for micro containment, which we increasingly call playbook, is a lot more prepared. Lastly, but an important point, I think while we all were worried about the health of the franchise, it did not. This time we're really worried about the health of our employees, and given the given the high transmissibility and more lethal as it seems, and are closely monitoring the situation. We had a reasonably generous financial aid program last year. The company spent 37 odd crores on that. We've reinitiated that program. We also decided to, we've initiated work with vaccine producers to vaccinate all our employees and our associates as quickly as we can, and the company will bear the cost of it. That's the preliminary assessment. Let me just quickly run through panel number. Just move. Let me just give you an update on business transformation, which is really what we are most excited about. Fundamentally, as you're aware, for our panel number 10, the 3-in-1 financial services for our, let's say, by the time we launch this, we will be 51, 52 million customers that we are launching as an omni-channel frame for our franchise. We will launch as an update form on our Expedia app. I think by the time we launch, we will have 10 million customers on it already. At this point in time, we have 7.5 million Expedia users. So it'll cut short or shorten the onboarding process significantly. Parallelly, as we do this, the productivity apps, our sales app ecosystem, our merchant app ecosystem, collections app, and partner app ecosystem will go live between May and September in a phased manner again. Between now and we are virtually into May, between May and September. The Bajaj Pay for consumers, which is our payment infrastructure, the BBPS service has gone live, UPI and CUG has gone live, and we are just waiting for regulatory clearance for PPI is ready to go live. We are just waiting for approval for the wallet business for the PPI business to go live. The 3 marketplaces, which is our e-store, insurance, and investment marketplace, are in advanced stages of development at this one time. The first phase of e-store has gone live in February. We have now 25,000 SKUs on it for our consumer electronics business. 40,000 retailers have been onboarded, and the final capabilities of the e-store will go live between July and August 21. The insurance and investment marketplace will go live between July and August as well. The onboarding app of Bajaj Financial Securities has gone live, and the trading app will go live on 31st of May. 12 adjunct partner apps are already live, and overall 28 apps will go live as the 3-in-1 financial services goes live. Quickly on customer experience, I had outlined that we are clear that if we have to be a moment of truth company, we will need significant transformation in customer engagement and experience. We think engagement is a function of engagement comes from service. So there's, just to give you texture, 33% of the overall app ecosystem is dedicated to service, just at a frame level. So clearly we think it will lead to, that is really the core reason why customers will engage more and will do more business with you. You see a set of points here on panel 7, on panel 11, the Exotel infrastructure is working quite well. 15-16% of the calls are happening through that. We are deploying an AI solution to analyze these calls along with a bag of words. We open collection service desk across 10 branches. We are adding 7 more, so we'll go to 17. We are, on a proactive basis, we are investing in DRA certifications. 7,000 of our agents have already got trained. We'll cover that in full year. The NPS for collections, probably we are the only exception anywhere in this part of the world doing that. 97% of our customers are giving us 4 and 5 scores. So that's an update quickly. Let me just jump in the interest of time all the way down to how are we seeing the portfolio health to be. That's virtually down to panel so that I leave some time for questions. Panel 50. Okay. Yeah. This is Panel 49 fundamentally represents, I've talked about it, that fundamentally 141,000 crores of assets are in stage 1. OTS assets are 1,739 crores. Stage 2 is 5,000 and stage 3 is 2,731. Versus last year, as I've articulated, 3,100 crores is normal stage 2, versus that is 5, and 2,400 crores last year was stage 3, it is 2,731. And we had a coverage of 60, we had coverage of 59 in stage 3, 58.5 in stage 3, and we had a coverage of 19, we have a coverage of 25%. In general, this is I'm down to panel 50, 51, 52. Represents 13 of our different businesses. We have a red here, which is still our two-wheeler and three-wheeler financing business, which is still significantly behind where it was a year ago in terms of stage 1 assets. Other businesses have all caught up or are better off. The B2C loans is still behind by 108 odd basis points, and as a result, stage 2 there is higher by 120 odd basis points. Otherwise, rest of the businesses are back to where they were in February 20. This is not March 20. This is February 20, because March was so that's the reference point that we've used for the last 4 quarters that we continue to intend to use. So that's really the quarter gone by, and myself and my colleagues here are ready to take any questions that you may have.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Rakesh Prasad from Alda Capital. Please go ahead.
Hi, good evening. Question. I wanted to get a sense of your credit underwriting in terms of automated credit underwriting. What kind of products are you doing through automated digital methods? And any sense on what would that be on a total percentage of AUM? And how has that trended over the last 1 year?
So fundamentally, our B2B, which is the point of sale business, is the one which is quote unquote the fully underwritten, fully automated underwriting. Our B2C businesses are quasi automated because we fundamentally determine based on
Hello. 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 Hello.
as integral. Sales one app, merchant one app are integral to what we call the omni-channel infrastructure is integral to the overall design. It's important and that's why we are saying an omni-channel framework where customer will be able to transition in a frictionless manner between offline and online and vice versa. So I think that's something for you to remember. Now let's just take an example for a moment so that it becomes clear. Point of sale, you go to an e-store, you are on e-store at home, you look for a retailer in your vicinity, you identify product, you don't buy it, you go to, let's say, add to cart, and you left it. We realize that appliances is a high involvement category. We will fundamentally flow that lead to the store that you've chosen and the person, either to the retailer based on our arrangement or to the point of sale person that we have, who based on appointment will speak to you and assist you and help you call you to the store and do the transaction. That's one example of omni-channel. The other example of omni-channel, we may pre-approve you. You've downloaded the 3-in-1 financial services. You go, you do add to cart. But are not able to go ahead because you need some assistance or we need something from you. That lead based on a allocation methodology will flow to a particular person in the field who would assist you and help you go through the transaction. We are very clear that on the other hand, it may be an insurance product or an investment product that you may be able to buy in 3 clicks. It may be a broking account that you'll be able to, if you're a KRA customer, KRA onboard customer, you'll be able to open in 3 clicks. So it will differ product by product and nature of the product and the nature of the transaction. So the right way to look at it would be as it emerges between August and September, as you experience it as a consumer, that's really where the imagination would become more clearer. So we are as excited about launching this. Something Anup you're saying?
Also, as Rajiv rightly said that this is a O2O framework, which is the online to offline and offline to online. We are not taking a position that it is only online. It's a assisted O2O framework where if the customer desires, he can go all the way to disburse. If he needs assistance, we can call fairly quickly. I think the game here is how fast do I reach out, and that's where the moment of truth will really play out.
Got it. Thank you. That's helpful. Last, just clarification. So how will all of this relate with the Vittimarketsapp? Is it completely disconnected or become overlapping?
Vittimarketsapp is completely disconnected, but the company is helping us build a technology platform because we are in the middle of building 3-in-1 financial services. We are in the midst of significant transformation of our current core technology platform. So they are building the investments and insurance and e-store marketplace for us on an arm's length basis as a technology partner.
Got it. Thank you very much.
Thank you. Next question is from the line of Kuntal Shah from Oakland Capital. Please go ahead.
Hi, Rajiv and team. Thanks for taking my call. We lost you for some time in between. At least I did. This might be a repeated question.
Yeah.
I would just focus on the slide number 10, giving the transformation thing. Particularly two aspects that need your comments on, what would be the switching cost for the customers in the current existing other platforms pertaining to investment, insurance, e-stores, and the stickiness for you as on to justify the current acquisition cost, and your comment on, the fintechs which are acquiring customers spending crazily versus your cost of acquisition. Secondly, more comment on, how this arm length pricing is going to work between the parent company and this, because ultimately the platform owner owns the customer, not the service provider. So some clarity on who is owning the customer and how it will flow through between the two respective.
Okay. So first of all, Kuntal, as you can see on top on panel number 10, we are not building this for new customer acquisition. At a design level, as I've said in 2 panels before, we continue to originate customers at point of sale. That does not mean that this will not originate new customers as well. We see EMI card origination has now become a reasonably large standalone engine, digital engine for us. We are now originating anywhere between 60 to 45,000 paid customers and 60 to 70,000 approved customers on a month-on-month basis. We think as this ecosystem becomes large, it's very much possible that number will significantly expand. But leave that aside. Our focus is on originate at the point of sale, and acquire and cross-sell has really been our strategy, and that's really what this panel and platform is intended to serve. We have enough customers. We are very clear that we will be sometime in the near future we will be a 100 million customers company, given the distribution and the product portfolio that we bring to the table, and the geographic presence that we bring to the table. So that's one part. Omni-channel frame, originated point of sale, do more with them is really what this platform is for. Now, that's one part of the question that you asked me. They are a technology partner for us. Bajaj Vittimarkets is a technology partner on an arm's length basis. They are paid to build the technology. The way we work with various companies, whether it's, I don't want to give names, but we have various technology partners. Bajaj Vittimarkets is another important strategic group technology partner. That's really how we are doing this on a complete arm's length basis. Customer, as I said, belongs to us. Any customer who comes on this platform takes our product, belongs to us. So there is no confusion at all. Having said that, since there was an earlier question and there is this question, we created Bajaj Vittimarkets as a challenger in the group. That was our original objective, and that objective stays. They are a challenger. We are quote-unquote producers, if I may say so, between us, Bajaj Allianz Life Insurance Company, Bajaj Allianz General Insurance Company. We are producers. Among them, we happen to be somebody who is a producer and is a open architecture large distributor as well. So I understand the confusion that at times it can. We created them as a challenger to make sure that their space is very large. It's a growing space that can they create a distinct and a differentiated model to find a new way to originate customers. And that's really what they've been up to for the last 3.5 years. And they have their own journey, and we as a company have our own journey. They have their own customers, and we have our own customers. So there is no confusion in our mind. This just happened to be, you have to look at them as, you guys understand it easily, as Amazon and AWS. That's the easier way to look at them. They have 2 parts. They do business on their own, and they also do technology development. We are using their technology development arm. That's all, nothing else.
Okay, so Raju, just one question is, can we expect all the engagement metrics like DAU, MAU, churn rates, CAC, all to be published after the third quarter when this platform goes?
I would say, Kuntal, the way we are seeing it as is that we go live between August and September. We are already working on what I would call a phase 2 between. We know that given the large ecosystem that we are looking at creating, there will be optimization opportunities, and that's being polite. All large app ecosystems as they go live, that's really how the nature is. We do think there will be optimization opportunities that will appear in Q3 and early Q4. From end of Q4, from Q4 results onwards, we will start to publish. Answer is yes.
Okay. And what are the friction for switching costs from one platform to other? There are marketplaces right now, right? Insurance, investment. So what are the switching costs and stickiness consideration involved?
So the switching cost fundamentally appears as we see only in the mutual fund space. Otherwise, there are not a switching costs. You could. So that's the only place where I'm aware of there is a switch cost that appears if you move from a direct plan to if you move to a direct plan. Otherwise.
Rajiv, I meant from one platform to other, like, if somebody has a policy or a live account of mutual fund or FD in one marketplace, what are the inertia and the considerations to switch to your platform?
That's something that, see, Kuntal, we, at a design level, we are originating a customer at the point of sale. We offer him an ecosystem. We continue to give him rewards. We continue to reduce the friction for him. He will have a higher propensity to stay with you. I think that's at a frame level, that's the journey we're going to. We think this is really how this will become the present and the future of the company from a next 5-year standpoint. So I think while COVID has had many costs, I think it has significantly accelerated our orientation and our direction a lot more rapidly than we had actually planned before COVID.
So
and you see it play out very, very rapidly.
What kind of marketing budget we have in mind to acquire customers or at least make the products aware to a wide spread of potential customer base?
Kuntal, we like to deliver return on equity to our shareholders. In general, I'm reasonably miser on these. We will continue to originate customers at the point of sale. I've reiterated it 4th time. I won't repeat for the 5th time. Our origination frame is not changing. It may bring additional customers at no cost as a result of SEO. And a small 40-50 crores a year that I currently spend in marketing in SEM, so be it. We don't need more customers. We need greater engagement and we need greater share of the wallet. That we are super clear about.
Thank you. All the best.
Thank you.
Thank you. The next question is from the line of Satvik Jain from Perennial Fund. Please go ahead.
Yeah, thank you. So given the erratic lockdowns in most of the main states and cities, so could you walk us through what different you are doing versus the competition to maintain such good recovery rates?
When you say recovery rates, so in general, as I said, the capacity planning was significantly augmented in Q1 last year. If you recall, we virtually added a 33% additional debt management infrastructure in Q1 last year. That's one part of the conversation. 2, the incremental through the door acquisition is distinctly superior, very clearly. The B2B portfolio of ours, which is really where millions of customers are, has largely fully churned. If you see that on panel 50, you will get a texture of it. Just go to panel 50. If you see our B2B business, you see since December 18, which is virtually 8 quarters, we never saw it go past 99% in terms of being current. We are seeing them at 99.52. That's one point here. As I mentioned on panel number 7 or 8 earlier, that the incremental through the door acquisition is looking, and their current bucket bounce rates are looking significantly better. So, so it's a factor of both. What is coming through the door, and clearly how efficiently we are able to manage those clients is really what so far has played out in the last 6 months.
Right. Thank you so much. All the best for the future, and hope you stay safe.
Yes, that's important.
Thank you. The next question is from the line of Jignesh Shial from MK Global. Please go ahead.
Good evening, sir, and thanks for the opportunity. Firstly, congratulate on a good set of numbers and very valid disclosures that you have given. I had just a single question now. If I can see roughly around 840 crores of macro and management overlay, I can see it up right now. Any brief idea about what kind of credit cost are you looking for the current year as well as for the next year? At least for the current year, considering this COVID wave is still there, the second wave has already been there and businesses are getting affected and all. So any guidance of how we are going to utilize this particular overlay, or how will be the credit cost planning out for the current year?
So you would appreciate that it is, I've given you preliminary assessment. It would be, so let me place this into two parts. Prior to March 31st, or as this crisis started to unfold so rapidly, I would have confidently told you we'll look probably close to we'll look between 150 to 160 basis points. It could have even been lower given the kind of rate of recovery rates that we are seeing in the last 2-3 months. At this point in time, and we have transparently laid out the way we see the situation to be, we would have to wait for a little while for us to have a full view. The only point I wanted to make is that we are technically not carrying any baggage, rather carrying a surplus into the second wave. So I think that is what is very clear and important. How it play. It is also showing that the through the door acquisition is better. It is also showing that our collections infrastructure is much stronger. It is also showing that we'll remain open for business. If the three events which I talked about, which is the national lockdown doesn't happen, 3 to 4 large GDP contributing states don't go into simultaneous lockdown for 3 to 5 weeks, and there is, as a result of some of these events, there is no another moratorium, I think we should be between 150 to 170 basis points. It may be a little lagged. It may not be the case in Q1, but on a full year basis, I think sitting here, I would like to believe so, but we are as aware as all of us are.
Understood. And just one quickly, if I understood it correct, we had up an OTR offer to around 2,200 crore kind of an OTR we had offered, and 400 is already converted into normalized stage 2. And balances we are keeping as a stage 2 only, but under our own method, otherwise it would have been in stage 1. Is my understanding correct?
That's correct.
1,739 crores does not have any overdue, but because they have taken OTR, we have classified them as stage 2.
Okay. Thanks a lot, and all the best.
Thank you.
Thank you. Next question is from the line of Nischint Chawate from Kotak Securities Limited. Please go ahead.
A very simple question from my side. What was the total write-off in the quarter?
If you go to panel 6, it's specifically mentioned there that total 1,530 crores was written off.
1,530 crores was the additional write-off that we had done on account of COVID-related stress as well as on account of write-off policy change. Apart from that, we had 500 crores of normal write-off that happened in the quarter.
So total write-off were around 2,000 odd crores.
That's correct.
Okay, perfect. Thank you.
Thank you. The next question is from the line of Hasmukh Gala from Finvest Advisors. Please go ahead.
Yeah. Raju, congratulations for such a brave phrase you are putting up in this adverse time. Just would like to know, can you hear me?
Yes, I can hear you. Yes.
Yeah. Can you just tell me, how far we will be from our normal growth trajectory, etc., looking to the second wave, and we don't know how long it's going to start. And as you said, the moratorium and other issues that could come up. So how far we will be from a normal growth profile? So will you again be looking at the growth, or will you be looking more at the protection of assets? good quality assets. So what will be the strategy in FY22?
So look, and that's why I realize it's a fair question that will be asked. FY22 is a long year, and that's why we gave you a preliminary assessment the way we are seeing it at this point of time on panel number 8. No, just go to panel 8. Yeah, that's on panel 8, and we've exactly outlined to you the way we are seeing it. If these 3 events don't happen, we think we will deliver our long-term guidance matrix that we have outlined for many years: a 25-27% balance sheet growth and a 18 to 20% ROE, and the current gross NPA and net NPA numbers. If these 3 events don't happen, if they play out, then we'll have to see. The additional point that I made here is that I think we are a lot more braver. I think having faced first wave, which caught each one of us unprepared, financially and health-wise, I think a lot more preparation is there, which is really what you can see on panel 8 and point number 4. I think whether on new origination, service operations, or on collections in a work-from-home situation, we will continue to deliver 90-95% TAT. Is really the way we are looking at it. Even if the flows were to increase in an intermediate period, which is really what we saw last year, I think we have additional staffing in our debt management infrastructure to be able to support. So I can only go by our readiness. As I've said, even if the recovery was back-ended, which is possible if this goes beyond May end, the 3-in-1 financial services would have gone live. So I think, and we have not baked that as part of a plan this year. As part of a planning process, we have not baked that in, because as I said earlier to the respondent, that we think it will get launched in August, September. We are very clear there will be optimization opportunities. That's really how large app ecosystems work. And for next fiscal, it will be a big play, and that's why the entire management team is fully seized that it's without it that we have to deliver the long-term guidance matrix, and we've given them the resources for the same. So I can only comment on our readiness. Very hard to say how things will play out.
Okay. My second question is that out of the 9 different asset classes, which are the asset classes where we will see some good positive movement, maybe for the part of the year?
Look, if you see Q1Q movement for all the 8 asset classes, we are seeing momentum across.
Okay.
We were still a little behind in our B2C businesses, but otherwise across all, and that's why the overall growth was reasonably granular, whether it was mortgages or B2C or SME or B2B. It was on a Q1Q basis. If you look at them, they were all growing in a fine way. We will remain data dependent and act accordingly is really all that I would say. The last thing we would want to ever do, we're building this business with a long-term view, that if the data does not support, we are not going to chase growth, whatever it means. But if the data does support, we will accelerate growth. I am clear about that as well. So the readiness on both sides, the prudence requires that we play it that way. And the agility is going to be of a important dimension, is really what our assessment of the last 13 months.
Correct.
For agile, the more you can mobilize.
The last question from my side, any further thinking on banking part of it, which you had touched upon in the third quarter, that you are looking forward to what kind of guidelines come from RBI, and then you will decide the structure and all that, how to go about it. So any further thought process crystallized on that?
No, we as I said, we are awaiting, and based on that, we will advise.
Okay. Rajiv and team, thank you very much. Wish you all the best.
Thank you. Ladies and gentlemen, due to time constraint, we take the last question from the line of Hiren Ved from Alchemy Capital. Please go ahead.
Hi Rajiv and team. Congratulations for good set of numbers given the circumstances. I just have two questions. One is that our current cost to income ratio obviously is higher given that the momentum of business and the growth has come down. And I remember that, when we were talking about our digital transformation, one of the objectives was to structurally reduce the cost to income ratio.
Yes.
So would it be fair to say that we should see a two-stage reduction in cost to income from the current level? One is to go to a normalized pre-COVID, pre-Bajaj Finance transformation, and then because of the transformation initiative, you could see another step down structurally.
Yes, that's really how, without the digital transformation or so-called transformation plan, we were at 31.5%. So there's no reason for us to believe that we won't go there. But as you're rightly saying, as the operating leverage kicks in, as some of the transient pieces of the OPEX goes away as a result of the event, you will see that happen very clearly.
Okay. And my second question is that, considering what the country has gone through last year because of the first wave and a little bit of the second wave, do you believe that your addressable market would have got impacted? Which means, what I'm trying to say is that, let's say you have a credit underwriting framework, and if, let's say earlier in normal times, if you have 100 people, making an initial contact and finally 25 going through the door, do you now have to address 125 opportunities to get 25 through the door?
So Hiren, it's a fair question. I am looking at 2 million customers a quarter. I have a little more simpler view to life. In the last 2-3 quarters, not having faced it, I would like to believe without having in no manner, in fact, tightened underwriting standards. If you could originate 1.8 and 2 million customers, 2.2 million, 4 million customers, I will take it as it comes. I think very deep distribution, that's one part. Being in terms of geography and in terms of point of sale is ensuring that we can capture the market. And as Anup is rightly saying, that the overall competitive intensity from a credit also has taken a knock. Clearly, not too many P&Ls have the kind of ability to take this kind of shock. We write off, but I write off flowing it through P&L.
Right.
I don't write off as a balance sheet entry. If P&Ls have the power to take on write-off, they should take it on and run a prudent business. So we have that firepower. We run a conservative business. We think gross NPA and net NPA flow through the P&L reflects the true strength of a business, and we'll play along that way.
Got it. Thanks a lot and best of luck.
Thank you. And we'll keep growing customer franchise. 2 million at a time or 1.2 million.
Yeah. Sure.
Thank you. I would now like to hand the conference over to Ms. Bani Babji for closing comments.
On behalf of JM Financial, I would like to thank Mr. Rajiv Jain and senior management team, Bajaj Finance, and all the participants for joining us in the call today. Good evening and thank you.
Thank you. Thank you all so much for the late call. Really appreciate it. Thank you. Stay safe.
Ladies and gentlemen, on behalf of JM Financial Institutional Securities Limited, that concludes this conference. Thank you all for joining us, and you may now disconnect your lines.